What is this financial risk management all about? Three words: financial risk and management. First of all, what is the risk? Risk is probably a very difficult word to define. There are so many elements that go into it. One, there is an uncertainty, means there is some amount of deviation from what we expect. There is a randomness into it, and this randomness gets into a probability distribution. So there are different kinds of probabilities associated with different kinds of events. So there is a probability that is built into it. So anything that is uncertain and for which I am able to associate the probability of occurrence means something which I am able to quantify by associating a probability to the different kinds of outcomes, and finally looking at the expected values, the variance, and various numerical measures associated with that uncertainty. I am treating that as the risk. So probably in a broader sense, if I have to differentiate between risk and uncertainty, when I in the world of uncertainty, I don't even know the probabilities of occurrences. Whereas in the world of risk, we know the probability of occurrence. So I can very well look at risk as something which is quantifiable, whereas uncertainty is something which is the non-quantifiable counterpart of the risk. So if that is the case, when I have to combine these two words, financial risk. So it is purely coming out as what is that prospect of financial loss, or whatever is the risk that is associated with the financial outcomes. This is what we are linking it to the world of financial risk. So any kind of random changes, any kind of unforeseen changes that are coming up in the various risk factors leading to the financial losses is what gets treated as a part of the financial risk. And in the current day's world, how well I am able to mitigate these losses, what are the various actions that I am taking, how well I am able to measure, manage these losses is what is coming into the broader perspective of the financial risk management. And today, the whole world of risk management, or probably the financial risk management, could come out into three broader dimensions, right? The whole world of financial risk management, I can try to break it. I could get into many classifications as well, but yes, one, there could be a market risk, then there could be a credit risk, and then there is an operations risk. There could be many other investment risk, liquidity risk. Probably what I would like to do is all those names I can bundle out into one of these three itself. So whenever I am talking about the market risk, yes, it's a kind of a financial loss. What is the possibility of a financial loss that can occur because of some risk factors. What are the risk factors that it looks at? Some kind of changes in the market prices, market based prices, whether I talk about commodities market, stock market, whichever market, the market based prices or the market based rates. I could talk about the interest rate, the exchange rate. So because of changes in any of the market related stuff, if there is a possibility of the loss occurring for an entity, that entire possibilities of losses, that entire risks are studied under the broad header of market risk. Whereas when I'm looking at the credit risk part, it looks primarily from failure of a counterparty to make a promised payment. So default on a loan given. And probably when two parties get into some kind of a service, one party delivering the service, the other party absconding from it. All these credit, wherever some kind of a loan has been given, the loan is not repaid. All those come under the credit risk perspective. And any kind of losses that are coming up because of the internal failures, so probably people related failures, systems related failure, loss occurring because of failure of the systems, failure of the people, fraud, processes failing. So these kind of things, or even some external events like the natural disasters, etc., all these add up to what is called as the operations risk. So there are different entities, different, even much more broader classification or much more deeper classification can come into the world of financial risk management. Now here, what we generally see is, yes, objective wise, risk is something which is quantifiable in nature, which means always I am looking at the computation of the probability for it, the financial impact for it, and based on that, getting into an appropriate management activity. But at the same time, it's not purely quantitative also. There are some processes and practices of good risk management which we really need to be aware of. There is a qualitative aspects, there are judgment aspects, and the world of risk management even derives lots and lots of practices from the world of accounting. So there is a need to understand the other areas as well from the world of economics, where the economics talks very heavily about the welfare maximization or even the organization behavior, how the firms really behave. So, though there is a lot of usage of the sophisticated tools and techniques, mathematical processes, statistical algorithms, though there is a heavy usage of all of them, they have to be packaged with these kind of qualitative and judgmental aspects. Only then the risk management, the financial risk management is going to give some kind of benefits to the investors or to the various stakeholders who are involved in the process. Now, why should companies manage financial risks? Is it really essential? On one side, there is an argument which says if the individuals can diversify their investments, if that's the case, probably the individuals really don't want the companies to diversify because as a part of their individual diversification, they are investing in some companies which are heavily risk taking, some companies which are not that risk taking in search for higher returns, right? So if every company is diversifying, then the return for the individual investors will traditionally go down, and it's a very huge cost that is involved in terms of risk management from the company's standpoint. So if the individuals are diversifying, what is the need for companies also diversifying, which will duplicate the same effort? But this is where the real argument comes up, which says individuals do not have perfect access to the capital market. They, the insiders of the firm, the directors, the board, the senior management of the firm, they understand the business much more compared to the investors. So because of that information asymmetry that is there, obviously the information that is available with the investors is much lesser compared to the information that is available with the internal stakeholders of the firm. So because of this reason, a company which is doing a proper risk management, it can very well increase the value, because when there are no other kind of costs like bankruptcy costs, right? When there are no other costs like bankruptcy costs, or any other aspects relating to transaction costs, taxes, in a very ideal kind of an environment, probably I could recollect Modigliani and Miller theorem, which clearly says that in a very ideal theoretical world, no information asymmetry being present, all of them have the similar kind of information, no principal agent problem, the employees as well as the owners, they work with the same set of goals, no taxes, no transaction costs, no bankruptcy costs, no friction markets. In that entire kind of a structure, the financial structure of the firm is really irrelevant. Whether you are going with a debt or equity, it hardly matters, but that is not reality. So because of that, all these are very much present in the real day-to-day world market, which means when I'm doing risk management, I can really increase the value of the firm, because I am reducing the probability of the firm going bankrupt. I'm not taking that extreme kind of extreme kind of decisions which could result in the firm going bankrupt. I'm not taking the loan so severely that one bad year is going to add up to the losses of the firm drastically. Then, even we are saying information asymmetry does exist very heavy, which means when I'm doing a proper risk management, I can pass on better information to my investors, which could very well result in an improvisation of the overall value of the firm. Even allocation of the risks from an investor's standpoint, the allocation of the risk can happen much effectively, because the firm is having a much better information compared to the individual. And even just a simple thing you can really look at, if the risk management is not there, yes, profits in one year could be drastically higher, the profits in the other year could be much lesser, profits in third year could be even more. There is a heavy volatility in the profits, and heavy volatility in the profits will have a very big impact on the taxes. So I may end up paying more and more taxes, but by doing a proper risk management, I can very well control the taxes that I am paying, which means again I am improving the value of the firm. So overall, you could see that any firm which is managing its financial risks effectively is able to increase the value of the firm quite effectively. Now, why did this entire financial risk management come up. It's almost not more than 40-50 years since this buzzword has caught up. And that too in the last 1 to 2 decades is where probably the heavy focus on the financial risk management is coming up. What could be the reasons? First of all, the trading activity has phenomenally grown. Different kinds of markets, different volumes, different products. The trading activity, the number of shares traded on each of the stock exchange, the turnovers in the foreign exchange markets, the wide variety of instruments that are traded on different exchanges on the over the counter markets, the volumes in very many new instruments, and probably the new markets, geographies expanding, new instruments, even those instruments which were illiquid earlier, there has been a market that has been created for those illiquid. There has been a mortgage backed securities market, asset backed securities market, where they are completely, these instruments are created out of the mortgages which were considered to be illiquid. They are created out of student loans, commercial vehicle loans. So those products which were considered to be liquid, today there is a market even for those. So because of the trading activities, because of huge spurge in the trading activities, lots of people, there has to be a lot of focus with respect to the risk management, because there is a huge scope for losses in see, it's a gain of one is adding up to the loss of the other. In that situation, to what extent I can understand what is the risk that is inherent and how well I can address that risk becomes a very major concern. Similarly, the new world has come up today, the world of derivatives. For every product today, for every underlying asset today, there are multiple models of derivatives that are lying. There is a lot of derivatives are traded on the exchange, and at the same time, parallelly, there is a very heavily growing over the counter market, and lots of innovations are coming up, innovative products have come up, and this is what has increased or improved the derivative market so drastically. And at the same time, there has been a lot of volatility that has been bundled up because of these various instruments that are coming up. More and more volatility is a very clear indication of a higher financial risk, which means every firm has to really spend some time, energy, effort, as well as resources in terms of how well all these financial risks can be managed. And we could also see nowadays, probably in the last few decades, almost every market has been volatile. The stock market has been volatile. The exchange rate market has been volatile. The interest rates have been volatile. The commodity markets have been volatile, which means there is a very heavy necessity to understand the patterns of these various volatilities, and based on that take appropriate actions which can result in the overall losses being restricted to a minimum for any particular firm. Then, though this derivative market has grown by leaps and bounds, probably post 1990, I see that there are so many disasters that have occurred purely because of the improper usage of the derivatives. We see so many hundreds of case studies which talks about the risk management disasters, improper usage of derivatives really costing the company few billions of dollars, and few of them have to wind up their businesses as well. So, which means there has been a constant focus in terms of the processes, the practices, which can really make the firms manage their risk quite effectively. So, there has been a constant search in terms of good controls, good risk management controls. What is that needs to be put up? So the separation between the front office and back office, one of the major problems that was identified in majority of the disasters. And then we also talk about what are the kind of models typically brought about as value at risk kind of models to estimate the risks across the organization. There is a need for derivatives, different kinds of systems to actually handle the derivatives risk, and monitoring should be more and more effective. Disclosures, what kind of disclosures are required? All these things have been constantly searched out for, which can enhance the risk management practice of an organization, which is definitely contributing to the value addition. Then finally, I could see the information technology, the way it has boomed over the last few decades, clearly suggests that this is the tool for the attractive risk management, effective risk management, because there is a computational power. IT is bringing very heavy computational power. I can write sophisticated algorithms and it can really execute them within no time. The speed of execution is very heavy and the costs of computing have gone down quite drastically. All these things really contributed to using risk management very heavily because IT is really supporting the usage of the risk management activity. So today there has been a separate specialization, separate discipline for people who want to specialize in the world of financial risk management. And it really is a challenging space to get in. There is a lot of quantitative aspect as well as a qualitative judgmental aspect, and people can specialize within a financial risk management either in the market risk, credit risk, operations risk. All of them are equally challenging and all of them are real threats to the financial security of a company if not managed properly. So that's where the challenge lies. That's where the need of the day for many of the companies lies. So a very effective space to really get in, understanding the world of financial risk management, both for an individual as well as the firm, will really try to bring stability into the operations of the firm, and which will pave the way for the enhancement in the value of the firm as well as the value of the individual. All right.